All right, let's work through Haroo Company. Supplies used. When you see used, you think expense. And actually what I might do first is I might go through and identify if it's a deferral or an accrual item. Why not? Good practice. Supplies, if you see supplies, deferral. Equipment, deferral. Earned of previously customer deposit, that's unearned revenue, so deferral. Received but not paid, those are your buzzwords for accrual. Same thing here, not billed. Insurance has been used, deferral. Interest owed but not yet paid, accrual. Okay, just so we know what side of the spectrum we're on for our adjustments. All right, so let's go ahead and do our first one. So it's going to be supplies expense and credit the asset. All right, we want to reduce the asset because we've used up its value and increase the expense of $500. Okay. Equipment will last a total of 7 years. It was purchased at the beginning of the year. So do your formula, cost over life. Okay, so 21 over 7 years. So that gives us $3,000. Anytime you see equipment, your offset, your two accounts will be depreciation expense and accumulated depreciation. I'll go back and fill in the explanations later, just so we can keep it moving. 200 is earned. Earned, that means revenue. Gotta record revenue. And it was a previously recorded customer deposit. So you can use customer deposit or unearned revenue. Right? Same thing. And it was $200. Okay, I'll fill in the explanations later. Annual property tax received, not yet paid, definitely an accrual, we're talking expense. So remember we said you fill in the expense, you fill in the payable. So since we're talking about property taxes, let's go ahead and do property tax expense. Prop tax expense. You can say prop tax payable, you can say accounts payable, either way. It was 4,000. $800 of client work has been completed. That is going to be earned revenue, not yet billed. So let's go ahead and bill it or show it as a receivable. Okay. Insurance has been used. That's a prepaid expense. So insurance expense and decrease the asset. Prepaid insurance of 200. The next one was for interest on a bank loan. Interest owed, so it's going to be an expense. The interest will be paid, so it's not paid yet. So it's got to go to a payable. So we always said you just kind of fill in the expense, fill in the payable. So we'll go ahead and do that. Interest expense and interest payable. And there you go. Those are your adjusting entries. Of course, I'll go back and put in explanations and then I'll post the solution file. All right, good work.